can I please welcome our first panel onto stage, who will be talking about payments and the balance of power, banks versus credit card companies versus fintechs. We have Alex Hoffman, who is the co-founder and co-chief executive of Power to Brazil, Joseph Gorayeb, chief executive of HSBC Bahrain, Punit Shah, who is the EMEA leader for client success and solutioning at Onyx by JP Morgan, Otto Williams, who's a senior vice president and head of products for Visa, and Usman Ahmed, who's the group chief executive for the National Bank of Bahrain. Hello. Thanks very much for coming and agreeing to be on our panel. So this is all about the digital payments landscape and how it's changing and how that's changing the balance between how different payment providers work. But maybe we could start with a bit of scene setting. We've talked about how much the payments landscape is changing, how important it is. Punit, how actually are digital payments changing, and how is that changing the financial landscape?
Sure, wonderful. Thank you. Good morning, Alex, and good morning to my distinguished panelists. And good morning, Bahrain. It's great to be here. I think this is really a moment for the Middle East. You know, it's a golden era when you really think about the backdrop of increased market activity, but also really macro geopolitical and macroeconomic forces at play. We have seen a lot of liquidity really migrate to the region here in the Middle East. So naturally, this requires some sort of a rethinking in terms of how global organizations manage their money and effectively make the money work much harder for them. So we formed a thesis at JP Morgan, you know, based through our deep history in the region of banking, so many of you, that really we think that the future of financial markets, infrastructure, but also the payments landscape is developing such that we think commercial bank money will be the dominant form of money, especially when you think of how a bank works from a very abstract layer. You have M0 money from central banks and you have M1 money supplies from commercial banks. And we think that this is obviously the dominant force and here to stay. But really where we see some change happening is really around payment platforms and payment networks, moving away from a message-based network as it is today, where your information moves on a different rail to your payments, or to your value, sorry, but also the actual open loop network of tokenized movement of money, peer-to-peer settlements, which will enable 24/7 movements of money, you know, operating around the world, cross borders, will really take shape. And also we think that tokenization and the transition of financial markets to more of an atomic settlement model is going to be quite interesting as well. So where you have your delivery and your payment happening simultaneously. So all of this is relevant, and I think the key thing really is interoperability. So how do we make sure that all of these emerging platforms and technologies which exist will be able to operate seamlessly with everything else of existence today in terms of all of our, you know, legacy platforms of today. So interoperability is key. So these are just some of the things that we're thinking about in terms of what the future might look like, and you know how JP Morgan are adapting to that. But maybe I'll hand over to my fellow panelists to maybe add to that.
So we're talking about lots of changes, but many of the sort of big players with these changes are new, but many of them are still the same. So Joseph, you work in HSBC for TradFi. Can you talk to us a little bit about who's driving change in the digital landscape?
Yeah, I mean, evolution is no longer kind of the only driver of TradFIs, as you call them. It's about kind of how you can adapt to all these changes. And you know, this adaptation is multifaceted. You can develop your own digital solutions and deploy them to your clients. You can partner with fintechs because they have specific solutions that for specific needs. You have white labeling that's happening in the industry as well, where you take on and you use it for your own brand. And lastly is potentially buying fintechs that you worked with in the past. And so that's on the technology side. The other important part is you can develop technology, but if the culture of the organization does not change, you struggle to keep up with the ever-evolving landscape. As an example, at HSBC, digitize at scale is one of the 4 strategic pillars globally. So the tone from the top is very clear on digitization. And when the tone from the top is very clear, it's then the development, integration, embeddedness is so much simpler for a global organization like HSBC. Competition is a good thing. It keeps everybody on their toes. But I believe the theme that should kind of be focused on is more of collaboration between all the stakeholders. And at the center of it should always be the client experience and obviously the customer protection.
Alex, you co-founded and now run one of the challengers in this situation, an emerging fintech company. Could you tell us a little bit about how, from your perspective, fintech is disrupting the existing payments network?
What we are seeing is that most of the latest developments in the payment industry are based, as Pandit said, based on open finance initiatives and open platforms. And I don't know if you have heard about Pix. Pix is an instant payment system created by the Brazilian Central Bank in November 2020. It's the most used payment method in Brazil. It's 5 times the volume of credit card. And it's basically a payment infrastructure that new providers can plug into the system to create new disruptive products. Pix itself, it's a disruptive payment infrastructure. And just to take an example, we have launched recently in May a solution that is entering in a territory that is currently a monopoly of credit cards, which is the expenses of Brazilian tourists abroad. That is basically credit cards. And we have launched our international Pix that is already running in several Latin America countries, and we're expanding to Europe, that allows any Brazilian to pay using Pix worldwide. And that's an example of an open infrastructure that allows new providers and traditional providers to plug into the system to create new products out of it.
Now, Otto, you work for one of the existing monopolizers of payments, as we've just heard. Visa, obviously, very well established, but of course things aren't static there, are they? How is the cards industry adapting to changes in payments?
Thank you, Joshua. I appreciate the question. And we are democratizing payments. Look, we've seen significant amounts of change and transformation within the payments ecosystem. We're in 200 countries. We enable over 4 billion credentials for consumers and over 100 million merchants. And I can tell you, here in the CEMEA region, heading product for the region, about 90 countries, we still have about 60 million small, medium enterprises, small, medium businesses that are not yet digitized. We've seen that significantly accelerate, especially during the pandemic and coming out of the pandemic, because they had to get digitized. If people aren't showing up due to lockdown and you had to sell online, and fintechs were really driving that transformation. They were driving that change and they were enabling those SMEs. And why is that important? We have this research that shows that economies that digitize boost GDP by about 3 percentage points. And once you start to digitize your SMEs and your consumer payments, you begin to do more of that and you start to see a lot of those digital transactions. You can actually bring more working capital lending to those SMEs. And if you're an SME that only accepts face-to-face payments, maybe you get 100 people in footfall. Once you go digital, your products are now exposed to 1,000 people. And so potential for more sales. And so that's important. We've also seen wallets, rolled out by fintechs, rolled out by big tech players, and rolled out by banks that are digitally transforming as well. Instant onboarding and digital wallet payment experiences. The one aspect of wallets that I'm actually really excited about is digital remittances. And so for a lot of our markets, depend on remittances, and you have to inbound those remittances. We've enabled the ability to drop and terminate funds to 7 billion endpoints. And it's 4 billion cards and mobile money wallets and bank accounts on the Visa network. And that's why I said we're democratizing it. And we've opened it up to fintechs and big tech players and banks to be able to take advantage of that. And here's why it's important.
It improves the quality of lives of a lot of our citizens. And where you had to go stand in line for an hour to, receive money that has been sent to you at an exchange house, you no longer have to do that. It lands in a wallet, and instead of you going to stand in line for another hour to pay your utility bills, you can actually make that bill payment within the wallet as well. And the last trend that I'll just mention here, which we're seeing as Visa across our markets, is open banking. Bahrain has led that effort. I think 3 years ago, introduced the open banking framework here in Bahrain. We have made an investment in a born in Bahrain open banking gateway provider, Tarabut Gateway, because we believe in it and we want to take it to more of our markets. We've acquired Tink in Europe that's providing open banking. And so now we're able to innovate on open banking data to score and lend more and expand access to credit across a lot of our markets. And so we see tremendous opportunities in all of these areas, ranging from SME digitization to wallets and digital remittances, and also open banking as well.
Now, you've raised a fascinating and really important point there on the sort of the vast number of businesses who have previously been unserved by or underserved by payment networks, and the really exciting impact that serving them can have on the economy. What do you think the main blockers were for these 4 million SMEs that didn't have access to good enough access to payments were before, and what is the scope? How far can we democratize? What proportion of them can we bring in?
That's a great question, actually. And some of the blockers, that's why the pandemic was such a transforming period for a lot of our markets. Some of the blockers were regulatory as well. If the only way you had to onboard someone to a digital payment experience was that they had to sign, a paper document to be financially included, that's really difficult. And the eKYC that a lot of regulators introduced in their markets allowed for mass onboarding, and fintechs would come in and create a digital experience and onboard consumers digitally and not requiring paper signatures to be able to do that. So that was one transforming element. A lot of regulators also adopted global standards. And so if a fintech is going to enable a solution in the market, they don't want to have to rebuild stacks for each country that they're expanding into, because they're building on a global standard. For example, global QR or EMV, or our tokenization solution for tap to pay at the point of sale, like Apple Pay or Google Pay. They're able to roll that out across multiple markets at scale. And so regulatory changes have actually significantly unblocked that, and it also gives investors confidence that when they invest in a fintech or a partner, they're not going to be blocked by regulation in their ability to expand to multiple markets. So we've seen that. And we've also brought network scale capabilities to power these fintechs so that if you integrate into any one of our services once, it's available for you to go to 200 other countries and enable that service as well.
So we're talking about a sort of really encouraging trend in the direction of regulation, definitely an encouraging trend for the SMEs and the people who need access to payments. But Usman, we're also talking about competition, aren't we? Competition between existing traditional financial institutions, for instance, the National Bank of Bahrain, and new players. How are traditional financial institutions responding to this competition?
Thank you, Joshua. I think it's an incredibly exciting time to be in the financial services sector. And the competition that we're seeing is really driving transformative change, which is improving the customer experience and forcing everyone to think more from the customer's perspective. So, if you think about where Bahrain was a few years back, we did not have an instant payment system in the market. Today, every bank offers that as a basic product offering, and that has really helped remove a lot of friction from the day-to-day lives of consumers. It has allowed payments to be more secure. It has allowed payments to be cheaper. It has allowed us to have more velocity of trade within the consumers and the SMEs. And it's, served as a building block to allow banks to further innovate and transform their own digital platforms. So today, as we think about it, we see it as really expanding the scope of possibilities for banks. It's unimaginable, to see, like, to have imagined where we are today versus where would have been, just like, if you look at a few years ago, if that competitive forces were not, spurring us along. And we have had to, in fact, allocate consciously more and more tech budget towards driving digital transformation and change, and that's extremely positive for the future of finance. So we're very excited to be part of that, and we think that when we invest more for the sake of developing the sector more broadly, everybody benefits from it. And the model, with respect to finance and with respect to banking, has always been one where financial institutions have had multifaceted relationships with each other. They compete, they partner, they co-invest, and this is just another new wave of such activity that we're seeing.
So yet another example of competition driving sort of not just innovation, but almost kind of unpredictable innovation in existing sector. And I guess, Punit, in working for Onyx, you are an example of a financial institution, a long-standing financial institution trying to innovate to keep up with the competition. How do you see traditional financial institutions responding to competition?
Yeah, no, absolutely. And I think for us it's relatively simple, to be fair. And if I can just coin a term or an acronym really around ABCD, so AI, blockchain, cloud, and data. So these are the 4 pillars that we're focusing on. When you think of AI and you think of the force multiplier that AI will bring, not just to how we operate, but also the productivity and the efficiencies that AI will bring. And that's interesting. But when you combine that with blockchain, and that's the team that I'm a part of, Onyx, and what we're trying to solve for is really make information move real time, right? So peer to peer, allow money to settle again real time and atomically with finality, and also create tokenization platforms for assets where you can source liquidity for short periods, by exchanging cash for maybe tokenized collateral or securities. So when you combine these individual items and put them onto a single native ledger, and maybe to Otto's point, you can have smart contracts that will potentially generate tokens that will sit on these multi-asset wallets, becomes a really powerful feature, right? And we know today that many organizations are also cloud native. So, any application that we stand up today, I think the first port of call is whether it can be cloud built. And if it is, then please build it there, right? And data is transforming how companies operate. I think it's fundamental. It's part of the strategy of many organizations now. And everything that we do is informed by data. So that's how we see it. It's relatively simple, but there's a lot of nuance behind that. And that's what we're kind of striving for.
Now, Alex, we've talked a bit about competition between emerging players and traditional institutions, but it's not actually just about competition, is it? There's quite a lot of collaboration going on in this space. How, as well as competing with established institutions, how do you see fintechs collaborating with them?
First of all, we like to say that we are not married to any payment platform or payment method. We like to think ourselves as an advocate for the merchant's best consumer and best interests. We have a very long-term relationship with card schemes and acquirers and with all the major banks. And this mentality, this mindset of the traditional banks and the acquirers towards the fintechs, it was not always like that. Like, I've been around in the payment industry for 25 years, and we fintechs were seen like a competition, not a partner. But that changed. And we are creating products with the credit card schemes and the major banks, and they are seeing us and all the new providers as partners, and they are seeing that they cannot be anywhere, and they need local partners with expertise in local markets.
What do you think drove the change? What do you think led
I
traditional
think
institutions to start collaborating?
they cannot stop history from happening.
Was there a sort of critical mass, just nervousness that if we don't get on board with this?
Yes, yes,
Yeah.
I think so. I think so because, but they have the basic APIs, and like Otto said, they have a lot of infrastructure that are needed by fintechs because those infrastructures need a lot of money that fintechs and new providers cannot afford. So they are very important, and they are offering this infrastructure to for these new products to be built over it.
Yeah, and if I can just add to that, actually, so something that Otto mentioned is very interesting, and also what Alex is saying is that historically integrations with fintechs was difficult because for an incumbent who have deep technology stacks, very complex applications that are run on them, made it very difficult for that integration to be seamless and frictionless. But I think with regulation and the FCA and the OCC creating these sort of secure sandboxes where fintechs can collaborate with incumbents in a sort of controlled manner to test has made it a lot more sort of easier to integrate into incumbents. And I think that's kind of driving the force behind that partnership as well.
Sometimes also people see card companies as the bridge between fintechs and established banks. To what extent do you find cards being used as that, and how does it feel to be the bridge?
Bridging fintechs and traditional players. Now, this is really important because at the end of the day, traditional players are still, they're still heavily regulated entities. They've got to, someone's going to be responsible for sanction screening, AML, and everything else, fraud and risk management that goes along with the stuff. Fintechs may not necessarily be prepared for that level of exposure or financial exposure to their businesses. And so this partnership is important. And what we do is, fintechs have a lot of advantage that they're able to leverage, i.e., they don't have legacy infrastructure. And so going back to Punit's earlier point, it's AI, it's blockchain, it's cloud, and they can go to market, especially with cloud, first principles, accessing APIs, enabling AI, and bringing blockchain technology to their work. They're able to go to market with speed. The traditional banks may not have that. And the role that we play is coming in and saying to the fintechs, we'll give you access to global capabilities so you don't have to expend your venture raised funds on building engineering assets all the way from scratch in order to be able to move money across 200 countries, or in order to be able to enable your consumers to purchase from 100 million global merchants. You've got a consumer that still wants to purchase on Amazon. They want a Spotify and a Netflix subscription. They want to be able to make Google Play and Apple Pay purchases. And so you still have to enable that. And what we do as Visa is we bring infrastructure that fintechs can connect to once and have access to all of this existing base for digital commerce to continue to happen. And so that bridge is important. What we also do is we've got a program which we call Fintech Partner Connect, where we vet fintechs and bring them to our banks. Our banks also need loyalty fintechs that do AML or compliance as a service really well. They need fintechs that can do KYC really well, or risk and fraud management. And so we identify those fintechs, we vet them, and we bring them to our banks, and our banks actually partner. So we create that bridge as well. And then you've got a number of accelerators and incubators that also help to create this bridging mechanism. And to Punit's point, the regulatory sandboxes have actually been very helpful as well, because they allow fintechs to go to market and determine product market fit for what they're building before they actually fully commercialize it, and then they bring bank partners into that collaboration as well. So these are a number of areas that we found as just great bridging mechanisms.
One source of innovation and competition we haven't talked about, and we have many represented on the stage here, but we don't have big tech. Joseph, how much do you see the influence of big tech firms affecting everything we've been talking about?
Yeah, I mean, big tech are clearly making strides in our space over the past few years, and they're becoming large platform players. But they are often doing so by partnering. Again, it's that partnership angle with fintechs and with traditional banks, and it helps contextualize and offer an embedded financial service proposition to again the customer. So again comes back to the point that not one entity can do everything for the customer. It has to be through partnership, and we're seeing more and more of these partnerships develop and evolve. But I think there's also factors that one has to be careful about when you partner. And I think there's 5 factors that we need to be conscious about. There's scale. Scale is important. Some of these newcomers don't have the scale, so hence the requirement for partnership. The other side of the coin is those newcomers have usually high valuation, attracting investment. They're less bureaucratic than the traditional FIs, so that helps them develop ideas with less bureaucracy. The third one is about legacy, and I think Pune alluded to the traditional banks have legacy architecture, so fintech can come in and help them unpack this legacy architecture. And traditional FIs typically don't have that fintech mindset, finding those beautiful digital solutions to our customers. And lastly, risk. Banks have traditionally managed risk, and they do it well. Fintech can learn from the bank. So kind of these 5 factors we have to keep in mind as those partnerships develop.
Now, the title of our panel is The Balance of Power, because we're talking about lots of exciting things. We're talking about competition, driving innovation, driving greater access to payment networks, driving economic growth. It's all great, but we also want to sort of try and gauge how this is changing the financial industry itself. Usman, perhaps I can come to you. How do you see the balance of power shifting between different types of payment providers?
I think the answer to that will largely depend on how the incumbents respond or not. It's hard to generalize this across all markets and all sort of institutions, because there are some banks that are actually embracing the change and getting ahead of the curve and driving innovation and using that in combination with their own capabilities as having the balance sheet strength, the liquidity, the deposit base, the customer base, the technology and the compliance and risk management systems to really transform and drive the potential of the organizations to a different level. I think if they continue on that momentum and they have that self-awareness, at the same time remain very open to partnerships and leveraging on intermediaries, then they'll go from strength to strength. But for those who think that this is like a lost cause, or the balance of power is inevitably shifting, they might be stuck in a sort of sense of inertia and not really, and they will obviously be disrupted, right? So I think it's really driven by how the vision and the strategy is driven, while recognizing the inevitable forces that are at play today.
I guess an open question for the panel. Do we think that the way existing institutions will adapt to this is by developing new services in-house, or simply by looking at the emerging fintechs that are developing them and doing it via an M&A strategy? I guess Onyx is an in-house solution.
No, I think that's an interesting question, and I think if you just go back a step and you think about the last 2 decades, we've had asset price inflation that's really created trillions of paper wealth, right? But now we're in this kind of funny intersection of high interest rates, high inflation. So how do we understand what the future impact of that is, right, to equities and to debt? but also how do organizations and companies and individuals adapt to an environment where high rates will be sustained for probably a longer period, but also technology driving efficiencies, right, around your business model. So how do you kind of balance that? So it's interesting. So, to your point, do you invest in-house? And I think, from a JP Morgan vantage point, we're very fortunate that we have, a $15 billion yearly budget just for technology, right? There are 50,000 people that work at JP Morgan just working on technology. So there's a lot of things that we're looking at that we can do in-house, but also partnering with fintechs and, the emerging players out there. So, I mean, that's some of the considerations that, businesses should be, looking out for.
Yeah. If I can just add to that, it's got to be a combination. Some things you'll be able to build in-house,
Yeah.
but it's okay if you can't. You've got to partner, you've got to collaborate, you've got to acquire. And we're doing that as well. I mentioned earlier we acquired Tink, an open banking platform. I mean, we could have built an open banking capability and spent years doing that, or acquired. We just acquired Pismo. You'll know him out of Brazil. It's a core banking infrastructure, cloud-based, next generation that a lot of our banks need, and we want to bring that to them because we know it's going to take them 5 years just to upgrade their core banking platforms. And so we've got one in the cloud for you. We just announced $100 million generative AI investment fund where we want to invest in generative AI companies because we recognize that there's so much good tech out there and we want to be able to have access to it. And so I think this is what a lot of good companies recognize this, is that some things you will build, some things you will buy, and a lot of things you'll partner to achieve the outcomes that you want. And that's the view that many of our bank partners are taking, and that we encourage more of our bank partners to take as well.
At the end of the day, it's just a matter of time to market.
Exactly.
And if you think about it, I mean, TradFIs, and it was mentioned by the panel, they have legacy architecture. The regulatory landscape and the projects are coming thick and fast with traditional FI. So there's a lot of investment that is focused on that part of the business. So then you'll see more and more TradFIs, going and looking for solutions, opportunities, being opportunistic, as long as you're clear on the strategy and what your clients needs. An example of HSBC, you may have read the news. We bought the UK subsidiary of SVB. It was an opportunistic, M&A transaction, and it's a great business for a bank like HSBC to partner with some of the companies that are going to be coming up through this entity, and also learning. I mean, TradFIs have to also learn how kind of fintech thinks, and that's kind of the way we see the way for the future.
Again, Joseph, there's sort of another vantage point into. Sorry, we've taken to calling it TradFi. I don't actually do that usually. It's what the crypto people do, but we'll use it. We'll use it. What do you think the main factors are that will determine how the future balance of power plays out between different payment providers? What determines who does best out of it?
I think for most institutions, it's going to be placing the power, recognizing that we're really placing the power back with the consumer and with the customer. Ultimately, all of this really empowers the end user. If you think about it, we are all driving ourselves to partner, to collaborate, to compete, to innovate, to actually become more customer centric. Right. So I think that what it really forces us to do as an organization, as an industry, is to think about why we exist in the first place. We exist because we have a role to play in the lives of individuals and in the life cycle of companies to help them achieve their end objectives. The end objective is not banking or making that payment. It's something much bigger. And so for us, really, to think about it from the customer lens is very important, and try to place ourselves in the position of our customers and see what are the pain points that we need to remove, what are the frictions that we need to remove, how do we provide more safety, more security, and that will drive innovation, that will drive collaboration, and ultimately, the institutions that are most focused on that objective will really have more power in the ecosystem.
There are very clear benefits here from democratizing payments, introducing more sort of competition and therefore innovation into how payments work. Are there any risks to consumers and SMEs as their payment networks are rewired?
As I fully agree with what Osman said earlier, the consumer and the merchants are the winners here. And if you think about it, being able to show up at a merchant location and tap your phone to pay as opposed to fumbling with cash, that's just a better consumer experience. Or a merchant that's able to accept digital payments, you walk into a store and you scan a QR code and they get money in their bank account and now they can get more working capital. That's a win for that small merchant. Or a consumer's family sends money and they receive the remittance instantly on their wallet on the phone and can use that to pay bills. That's great. And you look at the MENA region, where we covered, there are about 67% of adults in the region. Over 130 million people are either unbanked or underbanked. There's still so much financial inclusion work that we need to do, and that's the consumers that get financially included and the merchants are going to be the winners in all of this at the end of the day. Access to credit. So many people are excluded from credit. We've seen buy now, pay later programs, show up. We've seen the ability to score on alternative data, and that's opening up access to credit for consumers to be able to spend more and merchants to be able to sell more. And so, at the end of the day, it's the consumers and the merchants that we serve that are going to win in all of this. Digitization there will be fraud and risk implications, and that's why scaled, trusted networks that can bring those capabilities and that are significantly investing in those capabilities are important. We've just announced an investment or a partnership in a platform called Excel that brings cybersecurity as a managed service to businesses. And you've seen a lot of businesses be exposed to cybersecurity fraud. And so this is the sort of stuff that you've got to, we are investing billions of dollars in risk and fraud management, and we want to make that available. But at the end of the day, these fintechs and big tech players are bringing, and banks that are transforming digital are bringing solutions that help consumers and merchants win eventually.
Do you think cybersecurity advances can keep up with the pace of innovation, though? Because that's the other side of, if there's a blistering pace of competition and innovation, that is great in terms of what SMEs can do with payments, but it also opens up new vulnerabilities, perhaps ones that people haven't thought of before because the system is changing so much.
So yeah, no, absolutely. I think if I can just add from a distributed ledger technology perspective, when regulation allows us to move to a public blockchain, for example, how do we manage digital identity? And that's really a big area of focus for us, right? Like, how do we do on-chain KYC, on-chain surveillance, AML, and things like that? So we're working with technologies that exist. Maybe that could be zero knowledge proof. There could be, a whole array of things. But this is really where we need expertise. We need clever research teams and institutions to help us through that and navigate that. But I think we were talking earlier off panel around quantum computing and maybe what that might do to cryptography. So there's so many different variances out there, which is very interesting, but also very challenging at the same time.
And I think it does expose the banks as well as the customers to new risks. You're absolutely right, Joshua. And when we think about investing for the future, so our tech budget, we think about it in 3 buckets. What do we need to do to become more customer centric, to grow the bank, to serve our customers better through digital? What do we need to do to just run the bank better, to be more efficient? I think you talked about that in your opening remarks as well. And then what do we need to do to protect the bank and the customers? So there's a whole sort of focus, conscious allocation of capital expenditure every year that goes into protecting against cybersecurity, protecting against fraud. With every innovation, there are more risks that come into play. And when we design products and solutions, we always have to think about what can go wrong and how do we introduce protection in our channels, and how do we introduce, authentication measures that will make customers feel comfortable. And this is where the banks play a very vital role, because by definition they're much more risk oriented than the fintechs. They've got the systems, they've got the historical data, the experience, they've got the compliance frameworks that they need to follow. And so that, the combination of having that orientation and being digitally sort of forward thinking is one that allows us to always keep an eye out for what can go wrong.
The timer is about to kick us off stage. It would be nice to end on a cheerier note than just talking about risks. So to anybody who can answer it before we get ejected, what do you think the best case scenario for the current payments revolution is in terms of economic growth, in terms of access? What's the dream scenario?
Let me just add first of all, I'd like to add something about the financial inclusion with a number, and how this innovation foster financial inclusion. Even though I said that the PIX is just 3 years and it's 5 times the volume of credit card, the credit card volume itself in these 3 years has doubled, which is a clear indication of that the pie is getting bigger. And the economic impact of innovation, uh, the Brazilian Central Bank projects the impact, the PIX impact will represent 2% of the GDP by 2026. So it's clearly this foster not only inclusion, financial inclusion, and power to the consumer, but also economic growth.
2% of GDP within a few years sounds
Yeah.
pretty good to me as a dream scenario. Thank you so much for joining me